Thank you very much. This is my first year at Web3 Summit. It's amazing so far. I've had a great experience, and it's one of my favorite conferences. It's great to meet all the people that I've talked to online about various projects. So I'm going to talk about real security for real digital assets. And just as a real quick intro, okay, cool. Just a quick background. I've been involved in digital cryptocurrency stuff pretty much as long as I've been involved in computing. I learned about David Chaum's blinded digital cash back in the 1990, 1991 when I was 11 years old, and I thought this is the most amazing thing that's ever happened. And then I spent a lot of the 90s as a teenager trying to find a way to build something on top of this. There were lots of IP concerns, and it was really too early to do it. We didn't have all the infrastructure to build this kind of stuff. But it was a really exciting process. In the course of this, I ended up moving to a Caribbean island because of the crypto restriction export from the US, the ITAR rules, and started a company there that was doing a gold-backed anonymous digital currency. Lots of cool stuff, and this was in 1997. And cool stuff there, had some hosting problems, so I started an offshore data haven in the North Sea called Havenco on this little self-declared sovereign platform, Principality of Sealand. And then I got involved in hardware security, travel security, like taking laptops into China and Russia and places like that, and Tezos. I mean, I've been involved in cryptocurrency or interested in cryptocurrency for a long time. I was on the crypto mailing list when Bitcoin came out, and always trying to find an interesting security angle to it. And I helped out a little bit with the Tezos fundraiser, and now I'm Chief Security Officer for the Tezos Foundation, on the Tezos Foundation board. And I also sort of strangely work on our securitization efforts, which has nothing to do with, well, sort of has something to do with security, but they're distinct things. So I get to work on both of those things, which is pretty fun. Okay, so this thing does not work. I'll just use the space bar. So I'm talking about real digital assets. So making a distinction here between real digital assets and cryptocurrencies, in that it's a little bit more difficult to do security for these digital assets. They have some different requirements, and the digital assets themselves are a mix of traditional assets that are being tokenized, as well as new kinds of assets that we haven't really thought of yet. And if you I like the analogy that people have of the internet adoption curve and the dates. People say we're in 1994, 1995 internet adoption in terms of overall cryptocurrency today, which is, I think, probably reasonably accurate. I would say in terms of tokenization of assets and things like this, we're probably in the late 80s, early 90s. So it's still very, very early. Cool. The unique characteristics of these kind of digital assets is they have much more difficult or much more challenging usability requirements for users. It's a complete mess of a regulatory compliance framework. Cryptocurrencies themselves at least have sort of a green field where no one really knows how they're regulated or whatever. But with tokenized assets of various kinds, you've got a whole mess of different overlapping regulations, as well as no one really knowing how they're regulated. So you've got a combination of this. They're really attractive targets for a lot of things. I mean, we have laws that are from the we have some truly ancient laws. We have a lot of laws from the 1930s that apply in the security world, and that's because of a lot of things that happened in the investment world back then that are very attractive to do to any asset still. So they're very challenging there. They're also really hard to roll back. It's possible in a cryptocurrency to handle a technical problem or a security problem by potentially forking it and reissuing assets. It's a lot harder to do the regulatory framework when you have all the other stuff involved. And the problem is you have to do a lot of the compliance and certification very early in the process before you've actually proven that there's a business case. So it's very challenging. Whereas with cryptocurrency, there's a much more of a sort of build something and see if it works mentality, and then build appropriate security measures as it gets adoption. With security of assets of this kind of asset, you end up having to do a lot of that work up front, which is very difficult from an organizational perspective. There's one of the big questions, which is pretty obvious, is whether you're going to use a public or private blockchain. I mean, both exist. It's really the issuer that makes the decision of a given asset, and they have cultures. Most of these are large banks or other asset holders, and they have a culture of internal IT. They're not they were very late to use public cloud services for even their regular IT. So getting them to use public systems is a challenge. I would say Ethereum, Stellar, and Tezos are the public blockchains that are being used, and Hyperledger is probably the primary one that's being used as a private blockchain. But there's been, it's very idiosyncratic on each asset what happened. There's a lot of people that moved from Ethereum public issues to private blockchains for purely performance reasons back when CryptoKitties was a huge fraction of the Ethereum network that would otherwise have stayed on a public blockchain. There's some people that want things like exchanges that have really high transaction per second requirements, others that have maybe transaction per month requirements. So it's sort of a, it's sort of a gray area, but I think we can look at the public blockchain version of this as its own thing, and private as its own thing. Just as an example, there's cross-chain crypto assets like wrapped tokens across chains. You use this for atomic swaps and for other things like that. This is a long history. I think people in like 2012, 2013 were doing some sidechain projects there and various things which are sort of a precursor of this kind of thing. These I would not really consider the same kind of digital assets because they're sophisticated users that are crypto native users, and it doesn't have as much regulatory hassle or legacy of legal history and everything else, so it's kind of an old thing. Staking bonds are probably the first asset that I would consider sort of the transition asset between pure crypto assets and more of these like digital security assets. They're really common in proof of stake systems as a way to prevent people from behaving badly, and they're real amounts of money. Like there's people who have millions and millions of dollars at risk for their performance, and if they double bake or if they do something else or double validate or whatever, they lose this money. So it's a meaningful amount of money at risk on online systems related to the execution of your system. It's not the same as mining, where if you just miss mining, you miss just for that time period. You have a pretty big thing. It's also a pretty good test case because they are sophisticated users, sort of by definition. They're validator nodes and other people like that understand the issues and things like that. Plus, it doesn't have as much regulatory overhead. The first asset class that's really been migrating to blockchains has been real estate. Just on Tezos, we've got 3 of these deals that have gone through the process, and I've gotten to see all the little difficulties with every implementation detail of it. There's also a couple projects on Ethereum, a couple projects on Stellar, and I believe there's a few others. So real estate as an asset class is something that is very attractive. There's a lot of reasons for that. It's huge values, there's like $200 trillion worth of real estate that is potentially available for this kind of thing. And if your metric for success is like assets on the chain, $200 trillion is a huge amount of money, and they trade very infrequently, maybe you have, the concept of a 30 or 100-year mortgage exists in real estate, so potentially you're not trading these assets very actively, but in other cases you are. And the technical requirements as a result are very weighted on security and an asset that will last for a long time, not necessarily for high throughput or anything like that. So they're an interesting class. There's traditional equities, which are stocks and various things, bonds, smaller companies, financings, whatever else. This is an area where some people have talked about doing it, but it's highly regulated, and the existing systems are pretty decent, so there's not as much. One of the issues with real estate is the technical systems behind it are so antiquated on the traditional systems that there's a huge gain to doing a new system, and maybe asset tokenization blockchain system is the right solution there. Traditional equities and bonds have been digitized really since the 70s, and they have pretty efficient trading systems. I mean, these are the people who developed like high frequency trading, and they rate custom drivers for their like Ethernet cards, and they build microwave links to replace fiber links to get like faster data connections. They're pretty technically sophisticated. There's some regulatory hassle, but it's a pretty sophisticated marketplace. So it's attractive, but not maybe the most attractive. The concept of equity financing, sort of like Kickstarter for financing your project as equity, is something that people come up with. Like pretty much every 2 or 3 years, someone comes up with this, and asset tokenization is potentially a good way, because it's very attractive. The problem is there's a lot of consumer protection regulations or investor protection regulations that apply to individual users or non-sophisticated investors that make it very difficult to have this kind of fundraising. However, there are exemptions for small fundraisers and small amounts in early stages and various laws. So it's attractive. But I mean, these are just asset classes that potentially exist. There's hundreds of new kinds of assets that exist that maybe we don't know some of them. Maybe some of them are concepts that people have are like taking an individual Airbnb apartment and securitizing the revenue stream for that and then going out and renting it out there. There was a crazy project that was happening. I mean, my background with the offshore data haven thing, there were some people building a floating platform off the coast of Thailand that were going to sell 20 of them. They're called ocean builders. They were building these like outside international waters things. And on the 14th of April, they were going to start, I was raising money to do purchasing 5 of them and then rent them out on the blockchain. On the 15th of April, the Thai Navy raided them and charged them with like felony treason and like a capital crime. So fortunately, I didn't get down there, but I think at some point someone's going to start tokenizing assets like that. So cool things like that. So what's unique about these things versus like traditional cryptocurrency? You've got very difficult or very sophisticated or very evolved legal interactions. I mean, each asset class has its own special field of law. Like you don't have just like a lawyer that does assets. You have like a real estate lawyer or a securities lawyer or something like that. And some of these laws are like hundreds or thousands of years old, especially in real estate. So there's a lot of history there. It's very different by jurisdiction. There's not, there's some commonality in concept, but I live in Puerto Rico, so we have the combination of US law and a lot of Spanish laws, and so there's interactions like that. There's places in California where there's Spanish land grant interacting with modern law, and that's just within one country that has the relatively young country with a lot of relatively recent laws. So you've got crazy stuff like that. And in the case of securities laws, in every jurisdiction has their own laws, which is sort of okay if you're thinking about countries, but within the US, every single state has its own securities law, particularly for offerings, and there are some carve-outs where you can meet exemptions for all of them, but it's very complicated to do an issue. And all these special laws have people behind them that make a lot of money doing stuff with them. Even just like financial printing to print information about annual reports and stuff in stocks is its own industry that has its own like incumbent firms that are trying to protect their thing. So it's really weird. And all of this is evolving. I mean, that's just for the traditional world, and if you also add blockchain to this, then people don't really have 100% on how these things are going to work. It's evolving. And every regulator is either trying to abdicate responsibility or make sure they have responsibility, and it's very, very complicated. One of the core concepts is KYC requirements for these kind of assets are very demanding. And they have a unique additional thing of if you are a sophisticated investor or an accredited investor or professional investor in various jurisdictions, you're allowed to buy riskier assets. Because a lot of this stuff is initially there to protect people from making bad investments. Because people would go out and they'd make claims about, hey, buy this land in Florida Everglades or buy this stock in this mine or something someplace. And they'd go out to a bunch of people that had never seen it before and take a bunch of money from them. They'd disappear. Maybe it was a fraud, maybe it was just a bad investment. And these people would lose their money, and then they would go to their regulators or their legislature or whatever and complain. And as a result, they passed a lot of laws to protect against that. And part of this, you can restrict on who's allowed to touch an asset. So maybe only these special people are allowed to touch an asset, maybe only people from certain countries. There's also requirements for a lot of issues. If it's an issue issued outside of the US, you can only have 300 US investors before a bunch of other regulatory stuff kicks in. So essentially you restrict the number of US investors that way. And all the liability here is on the issuer itself, not on the individual investor. So if you misrepresent your KYC status, potentially there's the concept of rescission where if somebody doesn't like what happened after the fact, they can then say, give me back my original money. And if that was an investment, then it might be an issue. And there's also a requirement from a lot of governments that you can claw back a transaction. If they say that a certain transaction was made improperly or somebody that shouldn't have this asset, then you have to claw it back. And the users are various degrees of sophistication, and the problem is you sort of have a barbell here. You have really unsophisticated technical users and really sophisticated technical users, and then you have people that are professional traders, professional asset managers, and you have individual investors. So you can't really assume we're just going to make it super simple and thus let users do what they need to do. But you also can't make it very complicated. So you have it's the hardest possible like user question. High profile is high risk. People are very motivated to attack these systems. They have liquid markets to take stuff out. And I mean, K&R, when you go out and you say something like we're issuing $1 billion asset or something like that, then kidnap and ransom risk on the people involved is a risk, as well as insider risk and everything else. So it's an issue. all the underlying infrastructure comes to play. I mean, this is the area where I would say people are already learning these problems, and they're fairly expert at it, but every stack that you layer on top of this stuff, if you issue an asset on top of a blockchain, all of the blockchain-specific security issues of that particular blockchain come to mind, plus everything that blockchain is implemented on top of. So the languages, whatever cloud providers, whatever infrastructure providers, network providers, everything else. So it's all there, and all this difficulty is front-loaded at the beginning of the project, and it's very expensive and very difficult to do. So that's sort of the sad part of it, but there's some cool tools and techniques that are available to help out with this stuff. I mean, cold storage is sort of the gold standard for this stuff. It's sort of in the same way that these assets are maybe 4 or 5 years behind the current state of the art in terms of where blockchain overall is. They also have their lower requirements, so you can get away with using slower transactions. And that's pretty useful. You can use, obviously you can do all the normal stuff like use cloud provider technologies. We've made pretty extensive use of AWS on a lot of stuff we built, particularly because it helps you solve the insider issues. I mean, you're obviously outsourcing a lot of risk to Amazon, but if you're looking as an asset issuer, your internal employees are the ones closest to the asset, and they have the most understanding of your system. And there's some benefit to outsourcing a lot of the stuff to well-defined APIs. Plus, there's just the fact that it's the standard benefits of cloud. Okay, so one of the cool things that happens in a lot of these things is people implement the same standard using multiple systems, which is cool because when you're implementing it in multiple languages, like we're doing a Rust shell for Tezos, and a lot of people have done, I know there's a lot of Ethereum efforts to do Rust as a second language. You find a lot of issues with your protocol specification that you were sort of corner cases and things, and you also lower the odds of a single bug from a single implementation being in your whole ecosystem. Of course, you can also add to your attack surface. HSMs are amazing. This is the area that I spend a lot of my time on. HSMs, everything from like the expensive SafeNet devices all the way to cloud products like Cloud HSM or Key Vault from Azure, to things like Ledger and Trezor. The issue with these is a lot of people use them just as a key storage, key signing device, and they don't put any application logic inside the secure envelope. So that makes things less robust against someone who has access to your machine and can compromise the machine. One of the cool things that Tezos has done is we have custom code that runs on the ledger itself. So maybe the ledger is not as secure as like as an Encipher or Tali's HSM, but if you run custom code inside it, it gives you a lot of benefits. You can do things like guarantee that only certain kinds of transactions are signed or things like that. So that's a cool feature, and that's available to a lot of things. You can also run custom code on HSMs. This is a big area of stuff. Platform security, a lot of people are using Intel SGX, which is a processor security technology, to implement a lot of that sort of like code signing stuff. Secure enclaves are an option if you're on an ARM platform. And in general, I would say this is an area of active research for a lot of people. One of the best features in the digital asset world of these sort of traditional assets is you can do multi-day settlement. You could do T+1, which is 1 day, or you could do later. So you can do initial trades but not final settlement until after the fact. And that lets you implement a lot of review procedures where you have a manual review process for a lot of stuff like that. And maybe you have transaction floor limits. I mean, the job that I would be most afraid of in the world would be being CISO of a live exchange, because they're the user of a regular exchange for regular cryptocurrency, because people are most conditioned to want immediate withdrawal of huge amounts of money. And as we've seen a bunch of times, if there's any sort of security problem, it's sort of a serious problem. Custodians, professional custodians or third-party custodians exist. You can outsource some of the problem, but you can't outsource the fundamental reliability or the fundamental responsibility. Sometimes this is required, sometimes not. The issue with these digital assets is often you need to be a securities custodian, which is different than a cryptocurrency custodian. So in some cases, your regular custodian is not an option, which is a sort of legacy thing. And then I would say smart contracts, so the technology that makes all of this possible. You're not going to have digital assets without smart contracts anyway. So I think the ability to write really interesting and sophisticated smart contracts that can do things like sophisticated multi-sig with multiple groups and things like that is a pretty important thing. So really what people have built are security tokens. They're standards from a couple companies that, or actually a bunch of companies, a few open source efforts and everything else, that basically took ERC-20, ERC-1155, and implemented these requirements into it. So you can do asset restrictions based on country, based on issuer, everything else. And then every time a transaction is made, it goes through a whitelist check. So it basically makes the token self-enforcing. You then have a lot of infrastructure around the issuance process and everything else. So it's a pretty sophisticated system. But I'd still say we're early days. There's not a true standard yet that everyone's using. Formal verification, as well as the sort of less formal audit and security audits, are great. It's obviously a nice thing to have, but there's issues. So there's things that are missing, and I would say a crypto ISAC, like industry-specific advisory committee or council, is something that would be really helpful, because a lot of these issues, I mean, somebody has a great quote of cryptocurrencies have a built-in bug bounty, and you can exploit it and just profit. So the issue there is if somebody exploits a single cryptocurrency, crypto people are more tolerant of that than traditional financial asset issuers would be when they're moving to a new platform. So if you exploit one, you might make some small profit off of it, but you set back the entire industry. So some sort of information sharing across the various platforms would be really nice. I'd say some sort of bug reporting or bug bounty system might be part of that. Some Zcash people had a really good idea on that, something more specific to the crypto industry. Test and simulation, and then certification standards. Like, we don't really know what certification standards and audit standards really apply to this world yet. So, cool. But yeah, that's pretty much an overview of asset security tokenization. If anyone has any questions, they're welcome to email me. And PGP key if anyone cares about like 99 PGP key. But yeah, cool.